You want to know the rule that 99% of traders don't follow? I'll tell you, and I'll tell you plain. It's the simplest rule in the game and the hardest one to keep. Sit tight. Not the rule of getting in. Not the rule of finding some whispered tip. Not the rule of reading the tape like a poet reads a psalm. No, the rule is to do nothing once you're right. Nothing. And nothing, my friend, is the hardest work in speculation. Every trader wants to trade. Every speculator thinks the business of speculation is the act itself. Buying, selling, hopping in, hopping out, catching this wiggle, that jiggle. They want to feel friction, feel the action. It makes them feel alive. But I'll tell you, the money isn't in the buying. The money isn't in the selling. The money is in the waiting. Tell me, be honest, how many times have you been right in your judgment and wrong in your pocketbook simply because you couldn't sit still? You read it right. You sensed the tone. You smelled the trend starting. You were dead right. And yet, by selling too soon, you made crumbs of what should have been a loaf. Or worse, after selling, you jumped back in because you thought you missed the real move. And that's when the market took you by the collar and slammed you against the wall to teach you that restless hands pay tuition, while patient hands collect dividends. The market punishes the restless. I learned this lesson when I was young, playing in bucket shops, scalping nickels and dimes. In those little rooms, being quick-worked for a time. You could be nimble and clever and get away with it because the limits were shallow and the game was small. But when I graduated to the real market, the tricks that earned me applause turned into a ticket to ruin. The real game is not catching pennies, it's catching the swing, the big swing. And you don't catch the big swing by hopping like a jack in the box. You catch it by getting in right and sitting tight. But sitting tight isn't natural. It offends a man's instincts. A man wants action. He wants to feel he's doing something. The minute the price dips a hair, he feels he must act. The minute he has a small profit, he feels he must take it before it slips away. He thinks the act of action is the antidote to danger. He's wrong. The antidote to danger is discipline, and discipline is often the discipline of doing nothing. You know this. You've lived it. How many times have you cut a profit short, frightened of vanishing gains, only to watch the stock march on without you? How often have you stood on the curb while the parade went by? The rule that 99% of traders don't follow is the rule of letting the market prove you right. Not half right, not almost right, but fully right. And that requires time. That requires patience. That requires character. Most traders think the danger lies in being wrong. They tell themselves the great risk is taking a losing trade. But the greater danger is being right and not letting rightness pay you. Direction without execution is a cruel teacher. Being right in thesis and wrong in practice is the bitterest pill a trader can swallow. And you've tasted it, haven't you? I know you have. It tastes like regret and sounds like, if only I held a little longer. Listen closely. The market doesn't reward brains as much as it rewards character. You can know, read, calculate, and memorize. But if you don't have the character to follow the one rule almost nobody follows to stay put when you're right, it won't save you. When I say sit tight, I don't mean be stubborn and a loser. Don't confuse the two. If you're wrong, get out. Immediately. The first loss is the best loss. But once you're right, once the market confirms your judgment, your job is not to do more. Your job is to do nothing. Nothing. And nothing is work harder than calculations, harder than counting, harder than calling turns. Nothing is a discipline of the nerves. It's the quiet act that separates operators from gamblers. I remember the panic years, times when I was short, and the tape was screaming down, and every nerve in me yelled, "Cover! Don't be greedy!" But I had trained myself for the dull courage of sitting, and the sitting made the money. Meanwhile, I watched other fellows who were right but broke the rule. They took profits too soon. They let fear rob them. They left the big money on the table and went home with crumbs. Fear and hope, these are the twin enemies. They ruin most men because they invert a trader's logic. A man holds a loser because he hopes it comes back. He sells a winner because he fears it will slip away. In other words, he hopes when he should fear, and fears when he should hope. He lives backward in the market. You say you understand? Good. Understanding doesn't pay. Doing pays. So, let's talk about how to do. We start with 2 laws. Old as time. Cut your losses quickly. Let your profits run. Every novice nods along. Almost none live by it. Why? Because the second law is where character is weighed. The first is a razor. The second is a grindstone. One demands a quick slice. The other demands a slow stillness. What does it mean to let your profits run? It means you let the market do the lifting. You don't try to manufacture profits by constant tinkering. You set your risk, you define your thesis, you enter with reason, and when you get the confirmation, you sit. You don't sit forever. You sit until the market shows you that your judgment is no longer correct. That means you exit because the trend broke, not because your nerves broke. That difference is everything. Let's draw the line plainly. Patience is not passivity. It is disciplined inactivity, while a correct position compounds in your favor. Patience is not stubbornness. It is disciplined flexibility when you're wrong. Patience is not detachment. It is engagement with rules rather than with feelings. Now, understand the psychology. The market is a great psychologist and an excellent con man. It pays to test. When you're in profit, it dangles small pullbacks to tempt you to take a neat gain. When you're in a loss, it teases bounces to keep you chained to hope. It plays your impulses like strings on a violin. And unless you master your fear and hope, you'll play the market's music as the prey, not the predator. Discipline is the antidote. But discipline isn't born in comfort. Discipline is forged in pain. The pain of watching your small gains vanish because you held them, only to learn the move was larger and you were right to hold. The pain of taking a loss fast and seeing it bounce after you exit, only to learn that the habit of cutting is more valuable than any single saved trade. Discipline is training your hands to obey your rules while your heart screams the opposite. Let me give you a picture. Imagine 3 waits. Wait to enter. You wait for the right setup, not the next trade. There is no prize for activity, only for accuracy. Wait for confirmation. You wait for the market to agree before you size conviction. Wait for the move. You wait through jiggles and jolts, through all the little temptations, until the trend is done, not your patience, the trend. Most men fail one of those waits. They get in too early, or they exit too early. The ones who make the money, they wait all 3. You want tactics? Good. Philosophy without practice is delay disguised as wisdom. Here are practices that force patience into your bones. 1. Pre-commit your exit logic. Write down your exit rules before you enter. Define what breaks your thesis. Is it a moving average cross? A break of structure? A volatility stop? Put it in ink. When the itch to act shows up, your rules speak louder than your nerves. You don't exit because you're scared. You exit because the reason you entered is gone. Graduated stop discipline. Use an initial stop to kill a bad trade quickly. When the trade moves in your favor and proves itself, trail your stop by structure, not by pennies. Structure means swing lows in an uptrend, swing highs in a downtrend, volatility envelopes, or ATR-based stops. Let the market breathe. Tight stops on a solid trend are like pulling up a sapling to check its roots. 3. Scale with purpose, not panic. If you must scale, do it on strength when a trend confirms, not out of fear at the first green candle. pyramid into winners with wider stops as trend maturity develops. But never average down a loser, never. That's hope wearing mathematics as a mask. Don't count dollars mid-trade. Count structure. Count higher lows and higher highs. Count retests and refusals. Money counting triggers fear. Structure reading reinforces patience. Codify the do-nothing state. Define a state explicitly called hold. In that state, your only allowed actions are move stops per plan, update targets per plan, log observations, no discretionary exit. If your plan says hold, you hold. Your job is to wait, not to invent reasons to act. Trade fewer, bigger ideas. Your patience is finite. Don't waste it on crumbs. Spend it on loaves. One great trend can pay for 10 average weeks. Learn to sit out second-rate setups. The patience to stay out is kin to the patience to stay in. Use time frames that match your temperament. If you can't sit 4 hours without fiddling, stop pretending you can hold a weekly trend. Either train your temperament or align your method with your actual patience. But know this, the big money still lives on the higher time frames. That is, the tax you pay for short-term thrills, you trade away the fattest edge in markets, trend persistence. 8. Journal the pain of early exits. Every time you cut a winner too soon, mark the final move you missed. Put numbers to regret. Quantify the cost of impatience. Make your future self feel the loss your present self digs. Pain remembered is discipline earned. 9. Separate risk of ruin from risk of discomfort. Exiting a loser reduces ruin. Exiting a winner reduces discomfort. One saves you, the other starves you. Learn which feeling you're obeying. Ritualize the sit. Use routines to keep your hands off the mouse. Time check-ins, end-of-bar decisions, alerts on levels not tick-by-tick watching. If you must stare at rules, not profit and loss. Now, let's revisit fear and hope with a surgeon's calm. Hope does not belong in losers. Hope is for your family, your faith, your future. The market does not rise for your wants, and it will not turn because you need it to. Hope in the market is a fire hazard in a room full of dry timber. Put it away. Fear does not belong in winners. Fear is useful to keep you alive in jungles and alleys. In markets, fear of losing a small gain is how you forfeit a large gain. Fear has a place. Fear of large losses. Fear of violating rules. Fear of ruin. But fear that smothers a trend is cowardice, masquerading as caution. This inversion, hope allocated to losers, fear allocated to winners, is the silent killer of accounts. And it is corrected not by knowledge, but by character. You know what to do. You must become the person who does it. So we return to character. Brains will tell you a stock is weak. Character will make you exit. Brains will tell you your trend is strong. Character will make you hold. Brains design a good system. Character keeps you from breaking it on a Wednesday afternoon because you got bored. Brains draft rules. Character lives by them. That is the hinge upon which the whole door swings. The market will test your character with losses and also with wins. You will taste success and feel taller than the room. Then you'll be tempted to size beyond your plan, to bend your rules, to think you've tamed the tide. The market allows this arrogance to ripen just enough, and then it sends a wave. Overconfidence is just as deadly as despair. Humility is your keel. Rules are your ballast. Without them, you flip. Now I will tell you stories, not to entertain you, but to etch principles into your patience. There was an operator who knew numbers like a banker knows debts. He held a sugar stock as it bled. Each day he told himself a new story. It will rebound. It can't go lower. That was hope, dressed as reason. He refused the first loss. He paid the final one. Later, he took a steal position that climbed like a well-made stair. At the first wobble, he sold. That was fear. 2 trades, same man, same mind, opposite mistakes. It wasn't the market that beat him. It was his misallocation of fear and hope. Another time, in a breaking market, I was short. Everything in me wanted action. Cover now. Take the neat turn. Book the praise. But I had learned to sit, to let the market pay me fully for being right. Instead of stealing my own wages with a premature exit, I sat. The sitting made the money. Others, just as right in idea, sold too soon and watched the market keep falling without them. They were correct and underpaid. I was correct and paid, not because I was smarter, but because I did the duller thing longer. Cleverness flatters. Patience pays. Cleverness makes headlines. Patience makes wealth. Cleverness is finite and drains a man. Patience is renewable. If you cultivate it, you can run out of tricks. But you can always wait. You think sitting is easy because it's nothing. That's the trap. Doing nothing when you should do nothing is the pinnacle of discipline. It is action against nature. It is your hand resisting the itch. It is intelligence restrained by character. Let me speak to exits, because exits are where men hemorrhage. Your exits must be dictated by the state of the market, not by the state of your nerves. If you entered on a daily trend break and confluence, why in the world are you exiting on a 5-minute candle tail? Your entry logic and exit logic must speak the same language. If you marry daily structure, you divorce intraday noise. If you build on long-term fundamentals, you do not file for divorce at the first quarterly wobble unless your fundamental thesis is broken. Align your time frame or commit slow sabotage. Define the signals that say, the move is done, not the signals that say, I am bored. Signals that end trends include a decisive break of trend structure with follow-through, a change in character, expanding downswings in an uptrend, expanding upswings in a downtrend, distribution or accumulation patterns that resolve against your side, volatility regime shift that invalidates your risk model. When those show, you act. Before those show, you sit. It's that simple to say and that hard to do. All right, what about adding to winners? You pyramid when the market pulls you forward by proving itself. You never add simply to feel active. You add because the structure matured, the risk shrank relative to the reward, and your initial thesis transformed into a stronger one. And every add carries its own stop logic. Never let a pyramid turn a good trade into a giant casualty. If your adds force your stop to widen beyond your plan, you are not pyramiding. You are gambling with borrowed time. Let's discuss the art of boredom. Boredom is a tax that patience pay. You must learn to endure it. Most amateurs flee boredom the way men flee silence. They think activity equals growth. In markets, activity often equals decay. Commissions, spreads, slippage, mistakes. You don't get paid per click. You get paid per good idea, held through its fruition. To train boredom tolerance, schedule your review times. If your strategy is end of day, only act end of day. Protect yourself from impulse by refusing to just check intraday. Use alerts at levels. Let the machine tap you when the river changes, not your nerves. Build a tracker of do-nothing days and celebrate them. Reward the behavior you want repeated. When you are flat, patience is not a void. It is a position. Cash is a position. The patience to stay out of garbage trades is the twin of the patience to stay in great trades. Many fortunes died not from bad entries but from the inability to sit in cash until the right one appeared. The market will always be there tomorrow. Your capital might not, if you insist on renting it to mediocrity. Now, temperament. Not everyone is built for every method. That is fine. But nobody is built for profits without patience. If you want long swings, you must accept drawdowns, pullbacks, shakeouts. If you want scalps, you must accept that the biggest edges will pass you. Every approach taxes you. Pick your tax and pay it with dignity. But know this: the lion's share of wealth in markets has historically belonged to trends and the patience that rides them. You can trade against that truth, but it will bill you. Let's go deeper into the mechanics of letting profits run. Use a trailing structure, not a trailing fear. Trailing structure means I will not exit until the last higher low is broken with conviction, or until my volatility stop is tagged. Trailing fear means it just gave back a day's profits. I can't stand it. One is rule, one is emotion. Normalize your drawdown expectations. If your backtests show a trend trade regularly retraces 30–40% of its swing before resuming, and you panic at 10%, the problem is not the market, it's your expectations. Align your mind with the math before the trade begins. Predefine partials if you must, but don't neuter the move. If you take 20% off to feed your lizard brain, fine, but leave the heart of the position untouched until the trend ends. Don't trick yourself into thinking you're riding when you've quietly sold your future. Size so you can sit. If your position is so large that normal volatility feels like death, you will sabotage yourself. Reduce size until you can sit through planned size swings without inventing reasons to break rules. The right size is the one your character can carry. Create if-then playbooks for common traps. If the market gaps against me, but holds structure intraday, then do nothing. If news spikes the price into my target zone without confirmation, then wait for a close, not a wick. Scripts reduce panic. Panic invents scripts you'll regret. We need to speak of identity. This game isn't just math, it's identity work. The person who exits out of fear is playing out a story about himself, maybe the story that he's safer, small, or that he doesn't deserve more, or that wins must be fragile. If you don't change that story, no tactic will hold. Decide what kind of operator you are, the one who can be dull enough to be rich. You have to like being boring when boring is profitable. You have to enjoy watching gains fluctuate like waves and learn to see those fluctuations as the tide still coming in. You have to redefine what doing something means. Sometimes, doing something means sitting on your hands. Let's talk about the opposite mistake, holding losers in the name of patience. That's not patience, that's denial. The first loss is the best loss because it's the smallest and because it keeps your identity intact. You remain the person who follows rules. It's cheaper to buy lessons early. Pay the small tuition with gratitude. The market sells expensive courses to those who refuse the cheap ones. And risk. True risk is not volatility. True risk is permanent impairment of capital. You reduce it by cutting losers and avoiding leverage you cannot survive. You also reduce it by letting winners compound, because big winners carry your campaign through inevitable dry spells. Now, some will ask, when exactly do I sit tight? And when exactly do I act? Good. Clarity matters. Sit tight when your thesis is intact. Your risk plan is unbreached. The trend structure is healthy. Higher highs and higher lows in longs. Lower highs and lower lows in shorts. The volatility regime is consistent with your entry regime. Volume confirms the path, or at least doesn't contradict it. Pullbacks are normal within historical behavior. Act decisively when your stop is hit. No debate. The structure breaks and confirms against you. The volatility regime shift invalidates your risk assumptions. New information destroys the foundation of your thesis. The market reaches a pre-planned terminal condition. Final targets, exhaustion, or time stop. Note the word pre-planned. Plans drafted in peace govern decisions made in war. You want another story? Consider the fellow who, after a string of small wins, decided he had earned a larger risk. He doubled size on a mediocre setup, broke his own rules, and the market obliged him with a lesson. He lost not just money, but trust in his system, in himself. That is the worst loss, because it erodes the foundation you need to sit tight when you're right next time. Protect your self-trust like gold. It's harder to mine than you think. Let's look at the math behind patience. Suppose your average winner, if fully realized, is 4R, and your average loser is 1R. But if you sell early, your realized winner shrinks to 1.5R. Suddenly, your expectancy collapses. You'll need near-perfect hit rates to break even, and perfect hit rates don't exist. Letting profits run is not motivational talk, it's mathematical necessity. Discipline preserves the edge. Impatience amputates it. But you protest. What if the market turns and I give back profits? Of course it turns eventually. Your job is not to prevent normal givebacks. Your job is to capture the meat of the move without confusing digestion for death. You don't exit because it exhales. You exit because it stops breathing. And here's a paradox you must accept. The moment of maximum discomfort often precedes continuation. Trends advance by punishing the impatient on both sides. They shake out the weak holders before moving again. If you exit wherever the crowd exits, you will share their fate. Small wins, big regrets. Train your eyes to see what matters. Your position is not a lottery ticket. It's a thesis married to a structure. Structure speaks in swing points, trend lines, consolidations, and breakouts. It whispers in volume. It announces in failed retests. Let those voices guide you. Never the profit and loss. Whispering seductions. We need to acknowledge time. Real trends take time. They must invite participants, lure doubters, repel latecomers, and finally exhaust themselves in a blaze of attention. You cannot compress this into your preferred calendar. Embrace the season. Farmers don't pull crops early because they're hungry. They stored food for the waiting. Build your storehouses. Financial. Risk small enough that waiting doesn't threaten your survival. Emotional. Support systems that keep you grounded. A routine. A journal. Accountability. Intellectual. A model you trust because you've seen it tested, not because you read it in a forum. I'll say it again, because repetition is the mother of mastery. Sitting tight does not mean sitting forever. It means sitting until the market proves your judgment outdated. The difference between a trend and a memory is structure. Let structure, not nerves, tell you when the memory begins. Let's get practical with a sample sit-tight protocol. Before entry, define thesis in one sentence. Define invalidation, the price behavior that proves the thesis wrong. Define target zones and the conditions that would signal exhaustion. Define trailing method, structure, or volatility-based. Define review intervals. For example, end of day only. During trade, only adjust stops per plan. Record each urge to exit early and the reason. Do not act on urges, only on rules. If price retraces within normal ranges and structure holds, do nothing. If a news shock hits, wait for your timeframes bar close before decisions, unless your stop triggers. After exit, grade the exit, rule-based or emotion-based. Measure the missed move if you left early. Log the cost. Note deviations and the triggers that caused them. Build countermeasures. Countermeasures for common urges. Urge. It gave back a day's profit. Response. Trend trades are not day trades. Check structure. If intact, hold. Urge. What if it crashes now? Response. Your stop is the what if. If a crash hits and still doesn't break structure, your rule is to hold. You are trading a plan, not a nightmare. Urge. Everyone on social media is taking profits. Response. Everyone on social media is not your system. Turn it off. Your method earns your life. Their dopamine earns likes. What about partial hedging instead of exiting? Advanced operators sometimes hedge a portion of exposure during event risk or at key levels. If you do this, predefine the hedge exit and its purpose. A hedge is not an emotional bandage. It's a tactic. If it becomes a comfort blanket, you're just paying spread to soothe nerves. Let's touch on humility. You are not owed a trend. You are not guaranteed a profit because you were patient. Patience multiplies edge. It does not create it out of thin air. Your job is to marry edge with character. Without edge, patience is a nap. Without patience, edge is a toy. And still, the heart of it remains. Character over cleverness. Cleverness can spot the turn. Character rides it. Cleverness makes 1,000 observations. Character makes one decision and keeps it made until the evidence changes. Cleverness will write books. Character will write deposits. Ask yourself, which voice will you obey at the next temptation? The voice that seeks relief or the voice that seeks reward? Relief is cheap and immediate. Reward is dear and delayed. Your wealth will be the sum of how often you choose reward over relief. When the next big move comes, and it will you have the nerve to sit? Will you have the patience to let your profit swell into a profit that matters? Will you let the market pay you fully for being right? Or will you accept crumbs for the comfort of saying, I did something? Build a life around this rule. Make patience your habit, humility your shield, rules your sword. Make your system small enough to live by and simple enough to execute when your blood runs hot. Plan in clarity so you can act in chaos. Practice boring so you can afford exciting. Remember, cut your losses quickly. It keeps you in the game. Let your profits run. It makes playing worth it. Don't overtrade. Action is not achievement. Follow the trend. Don't argue with the ocean. Sit tight when you're right. Be stubborn only with your rules, not with your opinions. In time, you'll notice something. The market will stop feeling like a beast to tame and start feeling like weather to work with. You won't try to stop the rain. You'll plant for the season. You won't fear the wind. You'll trim your sails. You won't chase every cloud. You'll ride the tide. And when someone asks you the secret, the rule that 99% don't follow, you'll smile. You'll say it softly because saying it loudly won't make it easier. You'll say, sit tight, and they'll nod, thinking they've learned something. But you'll know the truth. It isn't what they've learned that matters. It's what they can endure. When the candle wobbles against you for a day, and your profit and loss shrinks, you'll breathe and hold. When the room shouts, take it, and the chart whispers, not yet, you'll listen to the chart. When the market finishes the move, and your rules tell you the tide has turned, you'll exit without vanity and without regret, because you didn't leave from fear, and you didn't linger from hope. You left because the work was done. In that, you will become what this game rewards. Not the cleverest mind, but the strongest character. The man who can do the hardest simple thing longer than the crowd can bear. Sit tight. That's the rule.